Welcome to the TechExits Podcast. In today's Investors Corner, we take a deep dive into where tech investors are putting their money, exploring market trends, founder challenges, and what it really takes to navigate the complex world of tech M&A. Today, we have the pleasure of welcoming Rodolfo Elias Dieck, managing partner at Proeza Ventures, an early-stage fund launched in 2020 that invests globally in the mobility sector, including ground transportation, supply chain, logistics, and the energy transition. Rodolfo joins us to discuss Proeza Ventures' approach to investing and exits, including how they help portfolio companies prepare for acquisitions, their perspective on today's surge in tech exits, and what founders should know about navigating valuation, strategic relationships, and evolving market dynamics. So, let's begin. Rodolfo, thank you for joining us today.
Pleasure to be here with you today.
To start off, can you tell us a bit about Proeza Ventures? What's your investment thesis, and what stage and sectors do you mainly focus on?
Yeah, for sure. We're at Proeza Ventures. We're an early stage fund investing in all things mobility. What we mean by that is ground transportation, supply chain and logistics, and the energy transition. We launched the fund in 2020. We have made 22 investments, and we're investing globally. We're deploying about 70% of the fund in the Americas and the other 30% in Western Europe and Israel.
That's a pretty interesting approach, and Quorum's 2025 mid-year report showed a 21% increase in venture-backed tech exits in the first half of 2025 compared to last year. What's driving this surge from your perspective as a VC?
I think like everything, it might be a combination of factors, but some of the scale-ups or later stage VC-backed companies are acquiring smaller firms just to increase their team size or get a new product to market or complement their existing product offering. I think that's what's driving most of the activity right now. And at the same time, some of the earlier stage companies that might be having a hard time raising another round of financing might be looking for a home for their teams and their technology to keep on scaling their products. So I think it comes from both sides, where later stage companies are trying to justify their valuations that they got maybe in the peak of the cycle back in 2020, 2021, and are looking to increase or accelerate their revenue and growth. While at the same time, earlier stage companies that are finding a hard time raising are looking for other places to plug in their solution into and bring the whole team together with them.
Thanks, Rodolfo. And on the same topic, how do you think this environment compares to previous exit waves you've seen?
I think it's similar in some sense, in that most of the exits for venture-backed companies have usually come from M&A. I would say maybe rare, maybe might not be the best word, but it's not as common to go through the whole IPO cycle. It takes a long time to take a company public. But I think it's the new technology wave that is also pushing this. I mean, it's hard not to mention the words artificial intelligence in a meeting these days. So I think the push for new technologies and it's making a lot of more activity. There's a lot of dollars being deployed. I think the last statistic I read, it was more than half of the dollars, at least in the US market, that have gone towards AI companies. So that's driving a lot of the exit environment right now. Companies trying to acquire customer accounts or other products, legacy products, and then build AI products on top of that. And I think that's what's creating a lot of momentum and shift in the market right now.
Of course, it's definitely a switch from the past. As you know, VCs are involved in more than raising money. If a company on your portfolio is looking for an exit, how do you help them get prepared? What's Proeza's role in the process?
Yeah, that's a great question. I mean, for us, we're a seed stage investor. So when you invested early, you're always thinking about the big outcome several years from when you invest. But at the same time, we try to prepare the companies, basically the founding team, to understand that an exit is not going to happen overnight. It's not like you had a dream or a thought and say, okay, I'm going to sell the company tomorrow, and you go out and sell it. That's not usually how it works. You need to start first preparing all the fundamentals, covering all the bases in terms of having your all your legal paperwork, corporate governance documents, your financials, processes, everything well documented and ready for someone else to take a look at. And then, most importantly, you need to develop relationships with the potential strategic partners that might be interested in acquiring your company further down the line. Because at the end of the day, whoever's going to buy you is someone that already knows you and knows how you work, what you've been up to, what your product provides to customers, and your overall way of doing business. So that's the most likely buyer, someone that you already work with, maybe as a customer or a partner. And you need to develop those relationships early on. I think, I mean, probably VCs, but I think a lot of founders are maybe more romantic and think that they're going to go all the way through IPO or build a huge company on its own and remain independent. And they don't want to think about, okay, I'm building this company to sell to Y company in 3 years. But sometimes you need to have those exercises and just leave them in the drawer, but at least revisit them annually and see how you are accomplishing your goals and where you think your company is going and the needs of the market and who the likely buyers could be, and start developing those relationships via partnerships or customer interactions or you name it. But it's something that takes a long time to build. And then when the time is right, it happens, like they say, everything all at once. But it doesn't happen overnight because nobody sees all the work that you did prior to that moment where the timing was right for the deal to take place.
That sounds insightful, Rodolfo. Based on your experience in your portfolio companies, are you seeing more exits happening through strategic M&A, IPOs, or secondaries right now?
Yeah, I mean, right now it's like you said, there's a lot of M&A. The IPO window seems to be opening a little bit. There's been a few IPOs with very good market reception, perhaps uh, way better than what the bankers and the founders were expecting. A lot of money was left on the table given the huge bumps in the stock price in the first day of trading. And secondaries has made a lot of noise recently. That's been the key driver for distributions for VC funds right now, but still it's very small compared to the overall VC market. We need more secondaries to provide more liquidity. Right now, the ecosystem is kind of blocked in terms of there is no capital being recycled. Funds are struggling to raise funds. LPs don't want to make new commitments until they get distributions. So it's a full cycle that needs to work in synchrony for it to be helpful for everyone. Um, but yeah, I mean, right now we've seen in terms of our own portfolio, we've had some strategic inbound interest for a couple of our portfolio companies, and yeah, just strategics looking to acquire other skill sets, other technologies that complement their current product offering. That's been more or less the case since, yeah, probably since the last 18 months or so.
Of course. And you said market shifts constantly happen, especially in the VC environment. With the market shifts and the resurgences of M&A, has it changed how you guide founders on building for acquisition versus IPO?
Not really. I mean, again, given that we are very early stage investors, we usually, if we come to an exit, it's more likely going to be an M&A process, and we guide founders as to how to navigate those conversations. Before doing venture, I was in investment banking for a decade, so I have some experience running M&A processes, and I get close to the founders and just helping them guide the discussions and the key terms to negotiate, and maybe even running a formal process. I mean, because sometimes you get an inbound interest, but it might not be the best price, and you have a fiduciary duty as a board member. Usually, the CEOs are the part of the board, and sometimes they're even the chairman. They have a fiduciary duty to find the best offer for the company, and they want to provide the most value to all stakeholders. And running a short formal process might make sense as well. So you need to evaluate. It's on a case by case basis, but just understanding where you're sitting in, and if there's other potential suitors for your company, and pursue and do a very formal and a formal M&A process. And then, I mean, but having said that, out of our 22 investments, two went public via IPO. So we have that experience too. We weren't that close in that process, to be honest. More of the Series A and Series B investors took the lead. For us, there, the learning is how to manage public stock as a VC manager, as a VC fund manager, because we weren't expecting that early on when we first launched the fund. So just managing those shareholdings in a public market, that's been more of a challenge for us internally and not so much for the founders. But for the founders, I can say it's night and day. It's very different. You need to build a full compliance team and have all the governance in check, all your financials in check, and a bunch of other different things to be able to go public. But at this time, at this moment in time, we are not looking for an IPO in one of our portfolio companies, and I don't think we will be the best yeah, advisors for our founders to go public. I mean, other than sharing the experience that we have with these two companies that went public. But yeah, we are more used to having an M&A exit at the end of the day.
Thinking back to a recent exit you were involved in, was there something that caught your eye about how founders think or how buyers behave?
For any fund manager, um, one exit is one of more that will come because you have a portfolio of companies. For the founders, this is their whole net worth stock in one company. They've dedicated so much time and effort and sweat and tears and blood to building out their company that they want to make sure that they're selling at the right time at the right price to the right party. So it's something that we talk about with the founders quite a bit, and they really need to think about what that would represent for them personally and for all their stakeholders, their employees, their investors, the community, etc. Um, but I wouldn't say that we have changed our guidance for founders. It's just being more close to them and guiding them through these conversations. Um, Something that we've seen recently, for instance, from the buyer standpoint, is that sometimes you don't realize, right? We have, for instance, one company that is serving two industries, automotive and defense, military. And the company had a hard time raising funds on the automotive side, but was making some good progress on the military side and working closely with the Department of Defense and the Army in the United States. And that's something that the buyers looked into and they really liked, and that's why they decided to pursue an M&A opportunity with this company. With another one, we had another company that is working with both public and private sectors. Investors are usually, I couldn't say that they usually don't like working with the public sector that much. And sometimes we found that they weren't willing to invest because the company had some exposure to the public sector. But then a strategic player came and say, I love your public exposure. This is what I'm all for. And they like that. So you don't know what other people are going to like about your business. So it's always good to have um, other points of view and some different options so that you can cater to potentially different angles of that a buyer might be looking for.
I want to ask you about valuations, which is sometimes something that can bring misalignment between founders and VCs. How do you navigate that topic? And how do you handle situations where misalignment comes up?
Yeah, we've been involved in some of these conversations, and I mean, we all have to understand how the different stages of the company and the funds work. We had situations where we've had funds that have been invested in a company for 7 or 8 years, and they're obviously looking to get out and have some distributions back to their LPs. But there were new VC funds investing in the company that maybe the round wasn't big enough or they didn't allow for a secondary to happen. And then you have this weird dynamic with the new funds are betting on the future of the company, but the older or earlier funds want to get out. And then the pressure lies on the founding team, which is kind of a tough spot to be in. So it's basically, I would say, to have open communication and making sure that all the parties are aligned. And it's also important for the founders to, as the company evolves, to have the board composition evolve as well, so that you have people around the table that are committed to the company and to the success of the company, and not have this kind of difficult conversations at the board level that distract everyone from the business plan and how the company is executing. I think those conversations need to happen separately in a shareholders meeting on a different setting. And that's something that the founders need to learn how to navigate and be very open with all the parties. Because I mean, at the end of the day, we all understand where each fund is at its different stage of the cycle. And then maybe I would say that it falls more on the earlier VCs to find a secondary for them to sell their shares and have some distributions back and not put so much pressure on the founding team, unless there is a new round coming up where there's enough space for a new investor to say, okay, let's have a 20% or 30% secondary with this round and give some breathing room and clean up the cap table for the earlier funds. But it's like everything. You need to have open communication, trust, and an alignment between all the parties. And yeah, I mean, sometimes people are not going to be happy with the situations, but if you keep an honest and open conversation, I think you're going to get respect and you're going to be able to navigate difficult situations as they arise.
Now to a change of topic. Markets are always evolving and changing. Which sectors or technologies are you most excited about right now, and why?
Yeah, I mean, we're more of a specialized fund. We're investing in very specific industries, like I said, ground transportation, supply chain, energy transition. So we're very excited about that. Otherwise, we wouldn't be doing this. There's a little bit of headwinds right now with the trade war going on. There's a lot of noise, and that's been impacting some of the margins of the company, especially those working more with hardware products and working in clean tech solutions. But I would say we're very excited about the applications of new technologies into these specific sectors. Again, going back to AI, we've seen a lot of predictive maintenance plays. Also, AI being applied to supply chain and logistics to make the back office processes more efficient and seamless. And also AI applied to very on a vertical, very specialized way. For instance, we've seen companies launching AI products for car dealerships to help them increase their sales and their maintenance and service revenue, because a lot of the calls go unanswered. So you have an AI catching all the calls and redirecting them as needed. So we're seeing the applications of new technologies in the industries that we are participating in, and that's very exciting to see how AI was present in mobility 15 years ago when the first autonomous vehicles came to market in the DARPA challenge, or even more than 15 years now. But now with the new LLMs and the new technologies, new things are being implemented that before were not possible. And we're just seeing this new wave of autonomy 2.0, where you're seeing more automation in industrial settings, in construction, in mining, in ports. And that coupled with the shortage of labor across the US and in developed countries makes for a very interesting recipe, and where you're seeing a lot of interest from investors and corporates to incorporate some of these technologies and start testing them out.
We are almost wrapping up, Rodolfo. To hear some final insights for our listeners, we've talked about the pace of exits this first half of the year having an increase. Do you think this pace will continue through this year? Perhaps the next one? And do you have any advice for founders that want to jump into this wave of exits?
Yeah, I mean, I think the pace, I think is gonna hold steady as it has been throughout 2025 and maybe a part of 2026. It all depends on how the trade war keeps evolving and what the Fed does with the interest rates. But I think there's a lot of appetite to continue acquiring companies and adding service offerings to the portfolio of different companies. And I think for founders, I mean, it's not like I said, it's not going to happen overnight. So if you want to be a part of the next wave of exits, you need to start thinking about where your company is headed, where the market is, what are the current dynamics, and what the big players are, so you can identify who could potentially be interested in your company and start those relationships early on, because these processes take a lot of time and effort. So if someone is thinking about selling the company, first they need to look inward and have all their ducks in a row, like they say, have all the documentation, the financials, all the corporate governance very up to date. And then in parallel, start those conversations with potential players that could be interested in pursuing a partnership or an acquisition.
Thank you so much for your insights, Rodolfo. I think all of our listeners will greatly appreciate all of your advice and understand a bit more of the perspective of investors in M&A after hearing this.
No, thanks for having me again, and hope the audience enjoys the conversation.
Thank you for joining us today. Are you considering selling your tech company? Head over to quorumgroup.com, our tech exit sponsor. If you'd like to learn more about selling your tech company, join us at one of our Tech M&A Masterclass events. Attendees of the Tech M&A Masterclass will gain practical knowledge on how to achieve the maximum valuation for their company gained through expert-guided workshops, hands-on exercises, and M&A case studies, or online through our virtual conference and webcasts. Head over to wfs.com for more details. We'll see you again for the next episode.